Welcome to the Explainer. So if you're a focused learner looking to maximize your understanding, completely fluff-free, you are in the exact right place. Today we're looking at an investing premise that sounds, frankly, a little unbelievable. We're talking about a strategy that offers remarkably high rewards for incredibly low effort. Seriously, we're going to explore the concept of owning the game board instead of just playing the pieces.
Think about this. If I told you there's an investing strategy out there that consistently beats most professional fund managers, doesn't require you to pick a single individual stock, and takes maybe 5 minutes a month to manage, would you honestly believe me? I know, it sounds exactly like a late-night infomercial, but it is deeply grounded in financial reality.
Section 1. The Unbelievable Investing Strategy. Okay, let's dive right into this and uncover the mystery of how this specific tool achieves seemingly impossible results.
The answer to our mystery is the index fund. An index fund is a type of investment that totally flips the traditional script. Instead of hiring a manager who frantically tries to beat the market by finding the next big thing, an index fund simply tries to match the market. So instead of hunting for winners, you buy a tiny slice of every single company inside a specific market index. Take the S&P 500, for example. It tracks the 500 largest publicly traded companies in the U.S. An S&P 500 index fund buys shares in all 500 of those companies at once. It's that simple.
Section 2. Matching the market. This brings us to a really major philosophical shift in how we think about growing our money.
Let's contrast the two main mindsets here. On the active investing side, you've got the super stressful world of picking individual stocks. You're betting heavily that, say, Apple or Amazon will outperform everything else. On the flip side, we have passive investing. This is the index fund approach. When you invest passively, you aren't putting all your chips on one company. No, you're betting on the overall growth of the market itself. Basically, if the broader economy grows, your investment grows.
Section 3. Step-by-step mechanics. So how does this actually work behind the scenes? Let's peel back the curtain right now.
Watch how this builds. First, you put your money in, and the fund pools your cash together with thousands of other folks. Second, that massive pool of money gets automatically distributed across every company in the index based precisely on their size. And third, as the index updates, maybe a company shrinks and falls out of the top 500, or some new giant emerges, the fund automatically adjusts to match it. You literally do nothing. The fund handles all the invisible mechanics.
This brilliantly illustrates that proportional distribution. If Apple makes up roughly 7% of the S&P 500's total value, well then 7% of the fund's pooled money sits right there in Apple stock. If a much smaller company at the bottom of the list makes up just 0.1%, that's exactly what it gets. It makes the highly abstract concept of market capitalization incredibly concrete for your wallet. Your money simply mimics the exact makeup of the broader economy.
Section 4. 3 big advantages. Now that we know the mechanics, let's transition into the why. Let's outline why experts absolutely love this approach.
Advantage number 1. Diversification. Because your money is automatically spread across hundreds of different companies all at once, your individual risk drops dramatically. Your financial future isn't tied to the fate of one single CEO making a bad decision or one product completely flopping. If one company struggles, you have hundreds of others working to lift your portfolio right back up.
Advantage number 2 is low fees. Think about it. You aren't paying a team of highly compensated professional stock pickers to sit in an office guessing which stock is going to pop next. Because it's a completely automated process, just matching a list, the management costs are a tiny fraction of what actively managed funds charge. And in investing, every single dollar you save on fees is a dollar that stays in your account to compound and grow.
Advantage number 3. Consistency. The crucial point here is that very few people can consistently beat the market year after year. Historically, over long periods of time, these boring, automated index funds have actually outperformed the vast majority of those expensive, actively managed funds.
Section 5. The long-term trade-off. Of course, we need to ground this back in reality. There's no such thing as a perfect investment. Let's look at the trade-offs.
The unvarnished truth? Index funds are not magic, and you are absolutely not going to get rich overnight. Because you're matching the market, you're accepting the market's reality. That means when the broader market takes a dive and crashes, your fund goes down right along with it. There's no clever fund manager stepping in, moving to cash, or trying to protect you during a downturn. Nope, you're strapped into the roller coaster for the full ride, dips and all.
Because of that unshielded exposure to market drops, this strategy requires a very specific time frame.
We're talking 10 to 30 years. That is exactly who this strategy is built for. It's for long-term wealth builders and retirement savers who prioritize immense patience over quick, flashy wins. The strategy works because the broader market has historically always gone up over the span of decades, richly rewarding the folks who simply wait.
Which brings us to the ultimate takeaway of this entire explainer. To sum it all up, an index fund spreads your risk, keeps your costs remarkably low, and rewards your patience. Remember, it's not about picking winners. It's about owning the whole game board. Why drive yourself crazy trying to find the needle in the haystack when you can just buy the entire haystack?
I really hope this helped make index funds click for you. Now, if you are hungry to master the other side of the investing coin, ask yourself this: why do you get paid to lend money? In our next explainer, we're going to tackle exactly what a bond is and the fascinating reasons why governments and massive corporations are totally willing to pay you interest just to borrow your money. It's an incredible mechanism, and we'll break it down step by step. Until then, keep learning and stay focused.